Hello, everyone, and welcome to our webinar. Our presentation today is about harnessing digital banking to grow deposits profitably. And we chose this topic because inflation has catapulted deposits from a low priority issue to a top concern for banking executives across the country. With interest rates unlikely to change significantly in 2024 and 2025, the competitive landscape is fierce, and it may become more fierce if interest rates decline. We're looking forward to getting started here in a moment, but just two quick housekeeping items before we begin. If you'd like to submit a question for the Q&A section at the end, use the GoToWebinar menu in the top right-hand corner of your screen and click the Questions tab. I will read your questions at the end for our presenters. We will also share the recording and slides with you through the email you provided during registration, so look for that tomorrow. With that, I'd like to get us started by introducing our two presenters. Neil Stanley is the CEO and founder of the CorePoint, and Jim Wrigley is EVP of Growth Strategy for DeepTarget. Take it away, guys.
Thanks so much, Matt. Jim, it's great to be with you here today. I am excited about this topic. I'm excited about what you do with DeepTarget and really be able to share with this audience the toolkit that together we offer. And so what I'm going to do here is go through a little bit of the economic climate. Matt said a couple things that some of you might have found challenging about what interest rates are going to do. So we're going to give you some context for that, some understanding of where we're at. We're going to talk about what it is to negotiate deposits in this environment. And then Jim's going to take over and talk about where marketing fits and how to seize the marketing opportunities that are there. So that's what our agenda looks like. Many of you have heard me talk a little bit about the economy, but the thing about the economy, you never finish the book. There's always another chapter. And so today we're going to talk about what that chapter might look like. And it's going to go through these slides fairly quickly. As many of you know, we always put links to the economic information so that you can go out and get this information and update it for your ALCO, your board, have this information timely, no matter when in the future you want to pull it. So it's been kind of old news that the Fed fund target rate has been 5.25 to 5.50 now for over a year, since July of 23. And so we've lived in an environment that many of you didn't expect to have. And so what did that look like? What did it create? Well, it actually has created a little bit higher net interest margin than some of you thought we were going to get. The 338 is where we were a couple of quarters ago. And 317 was the net interest margin for the first quarter of 2024. What I've laid out here is the chart coming from 40 years of net interest margin data and the Fed fund rates accordingly. Of course, this impacts cost of funds, and cost of funds has been rising. We can see that one interesting fact is the cost of funds of the largest financial institutions has risen the most. And that's really contrary to the expectations of many community financial institution managers. But what's happened is that the larger banks in many cases have been stealing funds from the smaller financial institutions who have held the line on cost of funds. And holding the line makes a lot of sense. Hey, we don't want to spend more money than we need to, but have we given up profitable deposits? Today we want to really think about how to go get those deposits and make sure we secure them for us. One thing that we just found out when the FDIC posted its quarterly report is for the first time since the third quarter of 2007, the interest expense in the industry is now greater than all other operating expenses. That's in blue here is interest expense. All other operating expenses are in purple. And there was a time where salaries were much greater than interest expense. But now salaries, technology, facilities, when you put them all together, they're less than the interest expense for the quarter of the second quarter of 2024. So if you're dealing with this interest expense and you're thinking, well, you know, it's probably peaked, you know, Fed funds are going to drop. What's that going to look like? What I've done here is I've graphed since 2004 the graphic of Fed funds target rate in blue and the cost of funds in orange. Now, interestingly, yes, cost of funds has risen a lot. We just saw that it's now greater than all other non-interest expense. But what I want to draw your attention to is how different it was from the 2008 peak of cost of funds. Back then, it was 358. Today, it's 263. It's almost 100 basis points less, folks, even though Fed funds is actually just a little higher than it was back before the Great Recession. Now, why does that matter? If you're thinking that Fed funds are going to go down, which I do believe Fed funds are going to decline, I think we're all kind of thinking the same way. But the question is, how much will Fed funds decline and what will it do to cost of funds? I don't think that's a simple analysis. And the reason I think it's complicated is the loan to deposit ratios. Back in 2008, we had some financial institutions, those between 10 and 250 billion, had a loan to deposit ratio of over 100% as a group. This isn't an outlier. This is as a group, over 100%. So that is very different today. So when you lay in the loan to deposit rates of our industry on top of the Fed fund and cost of funds chart, you see a very different world that we're in right now. And the reason I bring this up is if you think the only correlation of cost of funds is Fed funds, what do you think is going to happen to loan to deposit rates if interest rates start to decline? Do you believe that you might get a few more loans if loans became more economically advantageous to your borrowers? If you got a few more loans, where are you going to get the deposits? If you're lowering deposit rates, how are you going to get the deposits? If the deposit competition heats up, which could happen. I know you've come in an environment where you think, wow, deposit competition is crazy. Well, when it was really brutal, interest rates were cost of funds was 100 basis points higher than it is now. So if it gets more brutal as interest rates fall, could it be the cost of funds doesn't decline? I think that's a big question. So keep in mind that we were in the mid 90s back then, we're in the mid 60s. Now we're a lot higher than the mid 50s where we were in the pandemic, but we're still in a position where there's a credit capacity that's much greater than what it was in the Great Recession. So how do we think about interest rates in the economy? I put together these charts. I freshened this chart this morning. So we have here GDP in blue. It's growing, folks. The economy is growing. Fed funds in green, it's flat. Unemployment actually dipped just a little bit. Now, I know it's higher than it was in some of these all-time low levels in the threes, but it actually is 4.2 now. So the idea of unemployment becoming a major problem is really a little bit suspect at this point. Now, when we look at the purple line, which is inflation, we're feeling good about it, and I'm gonna bring up some more data about that. But keep in mind that there's a transition going on in our economy, but it's not all bad. So GDP now, which you should be using, all of your ALCOs and boards should be looking at GDP now because it's the most relevant data for in the present. That's why they use the term now for this quarter. Now you can see it bounces around. It's relevant, but it's not always accurate. Just one particular data point isn't necessarily accurate. But as you get closer and closer to the quarter, which we're only now 18 days away from the end of the quarter, it's going to get more and more accurate. So right now, the GDP is estimated at 2.5% for this quarter. This is hardly a recession, folks. And when we look at inflation, that's what drove interest rates up, was inflation. It isn't benign. When we look at it, it's pretty easy to look at this chart and go, well, it looks to me like it's coming back under control. And let's just dig just a little deeper on this inflation. Now, these are 4 measures of inflation: CPI, Consumer Price Index, with and without food and energy, and PCE, which is the Fed's preferred measure of inflation. They do tend to move together, which is good. But what I'm going to do is I'm going to show you what that same graphic was, but only starting in 20. And so you can see very clearly the increase, the rise and the fall of inflation. And from this, you might conclude things seem to be well in hand. And I'm not going to say that they're out of control because they're obviously not going up dramatically, but let's take a deeper look at the exact same data, but positioned in a different way. What this is, it's percent change from a year ago. Percent change from a year ago. Well, reality is inflation is measured every month. And so when you look at the compounded annual rate of change, and you look at what it was back in the middle of 22, it's pretty close to where it is in the middle of 24. You can see the monthly impact, the monthly rate of change was in some cases 0. And it's bounced around somewhere between 2.5% and 5% for the last 2 years. Now, why does it look so different? Well, up here, we're comparing it from a year ago when rates were much higher. And as you come down, it's very easy to be better than we were a year ago. That's what this chart shows. This chart down here says, how are we doing right now? And so we were bouncing around until the fourth quarter of 23. And it looked like, if you don't look at this stuff over here, it looked like inflation was under control. And everyone started saying, Fed's going to lower rates, Fed's going to lower rates, until the first quarter of 24. And the world changed. And rates stayed at the 550 target level. Now we're back here again in the middle of 24. It kind of looks like things are under control, but the last couple data points, which the news media took as positive because they looked up here at what I'm showing you, that blue line looks like it's going down, but that exact same data doesn't look like it's going down to me. It looks like, if anything, it might be going up a little bit. Now, it's hard to tell, and as I said, we never write the final ending to this book. It's always a chapter at a time. So my sense of this is stay on guard. You can expect a rate decline. I do believe we're going to get a rate decline, but keep watching this month by month. Don't look at it superficially through the media's eyes. The other thing we need to do is we need to stop thinking about the last 15 years as normal. The last 15 years were not normal. We came through a Great Recession, which was very powerful in terms of creating a debt burden that in the private sector we had to live through and work out of, and it took us years. And that's why we had interest rates so low for so long. Many of you in the industry think that's normal to have a Fed fund rate of 1/4. It is not normal, and it's very unlikely that you're going to find in the rest of your career that that's going to be anywhere close to normal. So what we do is we took the Fed funds rate and we graphed it here. This is, you can get this link right here. It's coming right off of the Federal Reserve. And you can see what the Fed fund target rate has been. Now, we know back here in the 80s, that was crazy. No one's expecting that the Volcker years are going to return. But we also shouldn't think that the Bernanke years are going to return. So what's that going to look like? What I did here is I laid over the Fed fund rate the PCE core inflation. So when we compare those two, what we'll find if we pull the data, something I think very interesting. So if you go from 1960 to 2024, basically 64 years of data, you'll find that the median, I like to use medians rather than averages, the median Fed fund rate for all those years was 474. The median PCE inflation was 229, pretty close to what the Fed's wanting to do, right? That 2% that they're looking for. So they have reason to try to get to 2 because they're pretty close to that over a long period of time. But if you look at the spread between those two, you'll find that it is positive, 160 basis points, 163 basis points of difference between PCE inflation and Fed funds. Now, if you take the period after the Great Recession out, you don't look at it since the Great Recession, then Fed funds are 542 median and PCE is 307, which is a 260 basis points. So what that would say to us is if we're going to have a 2% inflation rate and you don't think the last period of time has relevancy for some reason, then you could expect a Fed fund rate of around 450, 2% inflation plus 260 spread. Now, I'm not trying to say that anything past the Great Recession was completely irrelevant. But I can tell you this, the 2008 to 2024 data, the median was 19 basis points and inflation was 164, which would lead some people to say, well, it's okay to have Fed fund rate below the inflation rate. That is not normal. That is not typical. And it was 112 basis points below. I think you can pretty much eliminate this as a likelihood. So as you're setting expectations for your bank, as you're looking at your interest rate risk scenarios and the likelihood of different Fed fund target rates, I'm going to suggest you look at what you think inflation is going to be, and you do something that is based upon an educated assessment of 160 basis points over to maybe something more like 200 basis points over. So there's always an evolution in the economy, but if it was 160 over a 2% inflation, that'd be 360 would be a target Fed fund rate. If it was 250 over a 2.5% inflation rate, then you'd be looking at almost 5% for a Fed fund target. So I hope that's helpful to just give you context. There is a economic resources link here that gives you a whole bunch of what I showed you here and more. I just discovered this YouTube. I sat in a session that was hosted by the folks at Taylor Advisors, and Omar presented this on how the economy works in 30 minutes. You may, when you look at this, say it's simple and easy, or you may say, wow, we really need to understand this, and my team needs to understand this. So I commend it to you. Obviously, we're not going to play any of it for you here. It's 30 minutes long, but I think you might find it to be highly beneficial to understanding the ecosystem, yes, the ecosystem that we live in, because there's too many of us who take very simple linear approaches to this. Oh, interest rates are going up, so that's going to hurt the economy. Well, actually, it's going to help some parts of the economy when interest rates go up. It's going to damage some, and there's an ecosystem that is going to be impacted. And this little presentation really helps bring that out. So it's the first time I've presented this to any audience, so I wanted to be sure to get it in here in this webinar. So to wrap up on the interest rates, this is what the Fed funds futures market is predicting. Now, the Fed funds futures market is relevant, but not necessarily accurate. It changes day to day. But right now, what the market is predicting, if you look at the CME Fed group, as of this morning, it's predicting that this time next, at the end of the year, it's going to be at 445 Fed funds. We're going to drop 100 basis points between now and the end of the year. And this time next year, the market is predicting we're going to be at 308. It's kind of interesting when we think about the dynamics I just talked about where inflation's likely to be. If inflation's 2, then the market's telling us that you're going to have 108 basis points above inflation would be where the target rate would be. So I put together a little YouTube on this topic. I commend that to you. You can see the history of deposits. You can see how it's fallen in terms of that 17.5 trillion. It started to go back up, but I wonder, it's going up with interest rates fairly high. If interest rates fall, what's the motivation to put more money in your bank? Makes one wonder, doesn't it? What will happen to deposits? And lastly here, we all need to understand how diverse we are. When you look at the 10th percentile and the 90th percentile, and you look at things like loan yields and investment yields and cost of funds, even though the median cost of funds or the average is 256, the differential between how you all operate is huge. And taking advantage of tools like DeepTarget is one of the ways you move in this category, because the opportunities are rich. Most people outside of banking think all banks are the same and they do all the same things. This tells us clearly, y'all are not the same and you don't do the same things. So taking advantage of tools like DeepTarget can be great at making a difference. The last thing I'm going to say about interest rates is that the interest rates offered and disclosed by organizations have never, in my opinion, over the 40 years I've been doing this, never had more diversity. At the time this was taken and it was published by the Financial Brand, 722 financial institutions had no rate above 1%. 671 offered rates between 1 and 2. 672 offered rates between 2 and 3. The highest rate offered, that's their highest rate. 1,172, 3 to 4. 2,183, 4 to 5. And over 1,000 financial institutions were offering rates above 5%. That was the maximum rate disclosed by those financial institutions. Now, we all know that there are retention offers and negotiated offers in addition to the disclosed, but I think this is a powerful analysis of how different we are and how the unique approach that you're taking is going to make a difference. So very quickly, I'm going to go through some of the things that we talk about regularly. We basically talk about how the industry does the same things that it did back in the 70s and 80s. We don't really have a professional approach in most financial institutions to deposits. And yet we have sleepers, curious, and shoppers in every market. And how you approach the sleepers, the curious, and the shoppers is going to be the difference between success and struggling. You should all have a sales process, have some powerful products, have a platform, train, and track results. This is what we have advocated for many years now. And the common tactics, there's a reason for doing some of these, but they all have flaws. But what we need to do is we need to make sure we take the best of each opportunity and we present it to the right people at the right time in the right way. So for example, a companion deposit account. This is something that we've done here at the CorePoint now for many years, and it's a bundled offer. And the bundling can be done by your front line. But there's a promotion opportunity here, folks, that exceeds what the front line can do on their own. And in this environment where Fed funds and Federal Home Loan Bank and US Treasuries and the disclosed rates, the promoted rates, the negotiated rates, and the retention rates are all in your domain. They're all part of what you have to navigate. It's time to professionalize this approach. And so, Jim, I'm going to turn this over to you. And hopefully I've teed it up in a way that has got everybody focused. So, Jim, it's all yours.
Gotcha. All right. Well, thank you, Neil. I always learn something when you're talking. I'm taking notes when you're talking. I really appreciate the partnership. So my name's Jim Wrigley, and I'm going to talk about the paradox of growth in deposits. And that is oftentimes when we talk about it, and I love this little graph, we're always looking for breadth, right? We want to open a new branch at the edge of town. We want new account holders. We want new members. And so that seems to be a focus from a marketing perspective. We talk about that all the time. But the truth is, why would we get a new checking account if we're not going to increase the number of products per account holder? So the idea here is that we want to go deep as well as go wide. And so I want to talk about how to go deep, because I think a lot of times people don't talk about how to go deep. And there is a way to go deep and get new deposits by that, what do you call them? The sleepers, the shoppers, and what was the third one, Neil?
Yeah, the content, or the curious.
And the curious, gotcha.
Mm-hmm.
Okay. So the idea is, if you can go to the next slide, Neil, is there's an optimum approach. And just to tell you a little bit about me, I've traveled inside of banks and credit unions to all 50 states, which I'm exhausted every time I say it. I actually wrote a book on sales. And I do think when we talk to banks all want a sales culture, but there's also been a little bit of a notion that we don't really want to advocate for our customers. So if you'll go to the next slide, I want to just make a point. And that is that the key to growth is the depth of your relationships. And in order to have a deeper relationship with your customers, there is some selling that needs to take place. There is some letting them know what the products and services are. And it's not a bad word when you think about the idea of providing your members or your account holders with what they need to be successful. And so how do we know what they need to be successful? Well, your data actually knows a lot about your individual people, and we can go in and take a peek, and that's what DeepTarget does. If you can go to the next slide, Neil. What we do is we address the problem of fostering meaningful connections with people that we seldom see. And so that's why the title of this was, In the Digital World, How to Take Advantage of Digital Opportunities. It used to be, for me, for example, I actually enjoyed, and people thought I was a weirdo, but I enjoyed going into the bank. Like I would go in and deposit, and this is not that very long ago. And the reason why I did was they said, "Hi, Jim, how are you?" They actually, one day when they had a book club, and the book club used my book, right? and they went over my book, and I spoke at the bank, and I met them all at the teller stand. So that's a relationship with the bank. But we don't have those relationships with the bank anymore. And what's tough is now our financial literacy falls because we're not going into the bank as account holders. So also there's personalized communication that can happen, as simple, how are you? People, we know someone's getting married, etc. We just don't have the relationships because they're not coming in. So what our solution does, and when the reason why we partnered with Neil, because he is so, it is so interesting what he does about targeting, is we are able to bring you verified growth in deposits and loan balances. I'll show you some reports by engaging with your often unlooked member base. And this is what I mean by the deeper relationships. We want to have more products per customer, but we don't want to just get them any old products. We want to get them products that make sense to them, that they would react to. So if we go to the next slide. Oh, so the problem is thus solved if we're able to do that. So here's how we do this. This is the path to guaranteed growth. And the first thing we do is we take your data in. There's all kinds of data security questions that will likely come, but we hash the data and we anonymize the data. And we haven't had anybody, after a period of time of understanding how we handle your data, get uncomfortable with that. So I just want to kind of get that out of the way. Those are questions you should ask. Those are questions we will answer if you're interested in this. But it is important to have a data-driven marketing approach. And I will tell you, having traveled around, as I mentioned, to all 50 states, I very seldom see people, they all talk about having a data-driven approach to their account holders, understanding who they are as people, right? Understanding who they are as in their financial lives. But when they don't use their data to do targeting or even understand this first step, I think it's a big missed opportunity. And so what we do is we take it in on a nightly basis. So we take all the core data that we come out of your system, put it into our system, and then we're able to put a couple of algorithms to that data. And we actually have an algorithm that identifies the next best product. And what I mean by the next best product is, if you have a checking account, we should not be advertising, because this is marketing in the end, the same high yielding checking account that you already have. We should not even use any of our time to say, hey, Frank, we need, you ought to get this. There's another example. If you don't have a mortgage, your data will reveal if you have a mortgage or not. We should not be sending a home equity line of credit offer to someone who doesn't have a mortgage. So it's not just it's not just what they don't have, it's also what they do have. So the data might reveal, for example, if you're trying to drive deposits and you have some kind of jumbo CD product or some specific product, we wouldn't want to advertise that to college students because they probably don't have the $50,000 sitting around or sitting in another bank account. So that's where the targeting comes in. That's where the insights come in, by taking the data and showing them. The line we use is we show them that we know them something, that we know something about them. Does that make sense? So the idea is, once we know something about them, and by the way, it's not just knowing their financial needs. We know their birthday. We know how long they've been at the bank. We know if they are using fraud alerts. We know if they're using e-statements. There's all kinds of things, communication, that we can increase our relationship with them by understanding their data. So that's step one, and that's not a very difficult process. Typically, this is an on switch. Many of you have digital bank. In fact, many of you, I would say all of you, have a digital banking platform. And in many cases, it's a matter of turning on this very system that I'm talking about. It's a switch that already exists. Maybe you just didn't know about it. So then what we're able to do from the data is, now we can target people. We can send specific ads to them. And I'm going to tell you some words that you can write down. We're going to send them an opportunity that is just for you. The words "just for you" is very attention getting, because if you're getting something from it, hey, Neil, I have something just for you, he's forced to say, as a human being, what is just for me? What is it? And there's a lot of different ways that you can do just for you. We can say just for people over 60. We can say just for college students, et cetera, et cetera. We can start to put people into buckets of opportunities so that we can do those sleepers and shoppers and curious people, and start to target them with these deposit products that, and Neil just explained, you need so desperately. Make sense? So not only can we do it targeted, but we can also do it personalized. So we can literally say, hey, Neil, right? On your digital online banking platform, we can personalize it. Hey, Neil, we have something just for you, because the computers have showed us that we do have something just for him. So now we're catching their attention with their first name, and we're catching their attention with something that they have a high propensity need. And I'll pause on that. High propensity need. Nobody likes advertising, and we can all agree on that, but everybody goes shopping. And we can all agree on that. Do you like to shop? Yes, I do. So it's basically people want to buy, they just don't want to be sold. So when I come back to the terms of selling, we're actually not selling them anything. We're just putting something in front of them that the data show that they have a high propensity ability to take advantage of, meeting their financial needs. Now we're building a relationship with them in such a way that we're actually sending ads only to people on an unlimited basis. By the way, if you had, I'll pick a number, 25,000 account holders, we can send 25,000 individual messages to those 25,000 people, different ones every single day. So that's the power of computing, right? So the best part about this is actually a third part is we want to make sure that we're not just spending money on marketing. And there's an old line that 50% of marketing is wasted. We just don't know which 50%. In our case, we know that it's not being wasted because we can see measurable results and we can celebrate those results with reports, what I'm going to show you in a second. What do I mean by measurable results? If we run an ad targeted on your digital banking platform that is just for you, and you click on it and you view it and you click on it and then you actually take out the product, we're going to know that you took out the product that we offered to you because you're on your digital banking platform, and because tied to that is we get your data on a nightly basis. So one day, Jim does not have a high yielding checking account, but he probably is a good propensity candidate based on the algorithms will show us that he probably has a high propensity need. He sees the ad, he clicks on the ad. He can actually open the account automatically right through the system by clicking on the ad and take them into your online opening account tool. And you have a new deposit and you didn't have any human interaction. And you had a personal relationship and you drove something that was just for them. And now you can see on the report that, wow, I ran the ad, they saw the ad, they clicked on the ad, they took out the product. And then further, we can put a dollar amount on average of what the value of that account was. So those are the three things that we do. And we're going to talk a little bit about what some of the reports look like. If we can go to the next slide, Neil. So the idea is, it's a couple of things. So if you have a problem of needing deposits, there's an expense, and then you can just click these fairly quickly. So the challenge is solvable. If it's solvable by money or loan, it's not a problem, it's just an expense. And it's an investment. If you click one more time, it's an expense that generates a return. It becomes an investment. And I'm going to show you how you pay for this investment. So you end up with a solution. So basically you spend a little bit of money and you have a solution because you have these documented returns that I'm going to show you the reports in a second. Now, the only other problem you have is, well, there's time, right? And then if you're going to do something new, it takes time, but we have a way with our service. It's a managed service. So it's a completely outsourced thing. So the time and effort is all handled on our side. So literally, we know that typical community banks, we hear this term all the time, a marketing team of one. You're going to gain a digital marketing expert if you go with the solution that I'm suggesting today. So going to the next slide. So the idea is, so let's take that word sell, right, and using persuasive techniques to convince someone to act, and throw that aside, right? What we do is we're going to focus on understanding your customers' needs and providing valuable solutions. So we close that gap that I talked about. The problem that we solve is we help members and account holders to be more financially successful in this easy automated way because the data leads us right to it. You will know who to run the ads to if they're sleepers, if they're shoppers, if they're curious, and you can drive new deposits as a result. So the word selling, right, because I wrote a book on selling, but I've been calling on banks and credit unions my whole career, it is a positive. It isn't, oh, here comes the heavy hit, the heavy-handed, over the top, overly persuasive, whatever. No, we're just assisting people with their financial needs. And when you do that in the right way, at the right time, with the right message, you can imagine they would take advantage of it. So if you go to the next slide, I want to show you some actual reports. So this is a deposit balance growth grid, just a sample. And the idea is that when we run these targeted ads, so now you understand what we're doing. We're going onto your digital banking platform. We're going into your data. We're targeting people. We're saying, Neil, we've got a special CD just for you, right? This shows the actual results, and you can get these reports so you can see how your deposit balances grow when you are talking to the sleepers and shoppers and curious, et cetera, in a way that they want to be spoken to. So we're not going to send this, if we have a high CD rate, we're not going to send it to everybody. We're going to send it to the people that have deposits that can take advantage, right? So not everyone's getting these ads. And in fact, once they take advantage of the ad that they get, we switch them to the next best product after so it's just a continual move forward. So you can drive deposit balances in a very significant way by targeting these ads on your platform. Go to the next slide. And you can imagine that if we can target deposit accounts, we can also target loan accounts. So same way here, we can see, so we were advocating some HELOCs and we were advocating some mortgages, et cetera, some auto loans. So we're able to drive loan balances as well. And going back to a slide where I talked about the expense, I want to just go next. Here's an example of I just picked one because we work with community banks and community credit unions all the time. So here's just a typical middle of America real customer. They pay just this doesn't cost a lot of money. They pay just $20,000 a year. That's the one cost. There's a setup fee one time and that's it. So $1,700 a month. I want to show you what $1,700 a month of targeted marketing can do. Next slide. Basically what we're able to do is we're able to advocate. I'll start with deposits because we're talking about deposits. So in the middle of the screen, you'll see the deposit accounts. We were able in July with this actual customer to drive 63 new CD products for a total of $3,100 of money. Some checking accounts we drove as well. We also sold some credit cards, some mortgages. These are from targeted ads. But if you compare the revenue that they brought in, that was recurring monthly revenue, because we just take 1 month, if they get a credit card, for example, it's not just 1 month of revenue, it's divided by 12, right? So they spent $17,000 and they made $16,000 as a return for running these targeted ads. This is what I mean by if it's an expense that has a return, it's an investment. If it's an investment that has documentation, it's a solution. And if you can't do the work, we can do all the work for you. So going to the next slide. You can see on an annual basis, all of a sudden we just take each month and this is what this actual credit union is doing. It just rolls forward. You get the idea. And you do have control. So interest rates change as Neil was talking about. So if it's products that are interest rate related, we have ways where we go into the system and we adjust the numbers of what we think we make on a consumer loan, on a credit card, on a HELOC, et cetera. We typically check that on a quarterly basis. We have a default screen that we start with and we offer it to the banks and credit unions and say, this is what we think on average our customers are making. Neil made a very good point that everybody is vastly different. So we do ask them to start with a default and then customize it to yourself so that we can get that 83,000 number very, very accurate to you. Now, it is an estimated amount, so we don't know for sure because it is the average balance. So we don't know for sure exactly. You know, there's a fine tuning that would want to be there. But one thing that is 100% accurate: 1,128 people in this example took advantage of the ads and opened them, and we can name all 1,128 people. So we know the names, so we know that that number is for sure. This 83,000 is this estimated influence sale number. So there's a little bit of fuzziness there. I noticed that there was a lot of CFO people on here. You will want to look at our default balances and make sure that they're tight with yours. So I want to just be heads up on that. Some people say, oh, that's not right. That's not right for you. It's right. It is right for this particular financial institution. These are real numbers that I'm showing you. So next slide. And just watching the time here, there is a way that we can do a demo for you of what it looks like on your digital banking platform. When I would say there is a way of doing that, we're not going to do it today because everyone has a different digital banking platform. So I'm going to describe it to you just briefly, and then you will be receiving an email from us that if you'd like to see a demo on your platform with your numbers, basically a customized presentation to you, we can look up or you can let us know either way what your digital banking platform is, Q2 or Banno or Access Softtech or whatever it may be. And what we're able to do is demonstrate what it actually looks like. What it looks like, just to quickly describe it, is it's just a banner ad that runs across the screen that says, hey, Neil, we have something just for you. It's this CD at that rate. Click here for more information. Or there is also a button, click here to open the account now, which I mentioned takes you right into the online account opening tool, and that will drop right into those deposit balance reports that I showed you. So we're not going to do the demo today just because it would be uninterested for a diverse audience. I can't really demo, you know, everybody's a little bit different. So I wanted to do that individually if this is catching your attention. Then we go to the next slide. And so the idea here is that if you are focused, and I tell people all the time, everyone would agree. Are you expanding? Are you acquiring somebody? Are you going broad? Yes, I am. Okay, if you're going broad and everyone says yes, why wouldn't you take the time to also go deep? And this is the way to, this is an organized, methodical way that you can go deep and take advantage of your digital real estate to drive these deposits that, as Neil said, are, you know, getting harder and have a greater need to come into your system. I think I got one more slide, Neil, if I'm not mistaken. So how will you use your digital banking real estate to better serve your members, your account holders, if you're a bank? The idea is it's sitting right there. I want to just kind of end on this note and turn it back to Neil. It is a switch, meaning with most of the digital banking platforms, and I didn't mention part of my career, I was head of sales at Q2, which is a digital banking platform company. It is a switch that is already integrated into most of the platforms that are out there. If it is not integrated in your platform right now, that's how we get the first one. So it's really a simple matter of saying, I want to do DeepTarget. We would contact your digital banking platform and then we would get it integrated. But for the majority of them, we have about 35 of them. It's a matter of, you know, hey, Jim, I want to do this. The fastest we've ever got somebody up and running ads is a week because it's a switch. So there's not a lot of technical work. There's a one hurdle, which is to get the data to us. There's some data extracts that you have to do to get the data over to us. We then analyze your data, manage it all within our system, and we'll tell you, here are the people that should be targeted for these various deposit products. And again, loan products if you wanted to do it as well. So that's my story, Neil. Thank you for the time. And we'll take questions at the end if there are questions. I think Neil's got a few more. We'll go from there.
Yeah, Jim, thank you so much. I'm looking forward to the Q&A section, but I can just tell you, this is why I'm so excited. I'm envious of some of the things that DeepTarget does. I looked at the offerings that Jim has just displayed to you, and I thought, wow, what a powerful combination to have the ability to execute on the things that we know are best practices in the industry. You know, just day in and day out, having people have the right product and structure them. That's what we do. Structure the product and have them in position for the front line to make that offer. But to execute with the digital platform like DeepTarget does is really exciting for me. So to kind of wrap this up in terms of the presentation, I'm going right back to that chart that just shows how consequential the interest expense is. It's greater than all other expenses. So if somebody in your organization is talking about how we're going to have to cut expenses, if you're going to cut expenses, do it where it makes the biggest impact. Yes, salaries are big, but interest expense is the thing that has grown from almost, I wouldn't say it was trivial, but it was minuscule compared to where it is today. You know, we're talking about $8 billion for the entire industry in a quarter, up to 144. It went from 8 to 144 in just a short period of time. And the opportunity that you have to better approach your funding situation, let alone the lending activity that Jim's talked about, if you just improved your funding on $1 billion by 40 basis points, it's $400,000 a month by having a better approach to cutting costs and getting some new deposits that you wouldn't otherwise have and making a spread on those. We're talking about a very important process. So many of you have already accessed our deposit best practices checklist. There's a video out there that I do. I have 53 sessions out there that you can access. But let me just pull down here. This is our best practices checklist. If you were to click on that, and what you'll see here is I've highlighted the things that DeepTarget can definitively enhance because they can go out and make the activity that we want the front line to do, but it's just not in their capacity to go do it like we could do it with technology. And so, yes, you should be making special one-time offers. Like a landlord CD and an election day promotion. You can promote that with targeted offers to the right people. The people, we've done so much in the industry of saying, we're gonna do new money only. Well, new money only sounds great in the ALCO, but it doesn't sound great to the people who are telling their customers, their best customers, you don't qualify because you already do business with us. The opportunity to target those offers and make sure you don't reprice your whole book. Jim's company is good at this. You can offer companion accounts. You can offer them at the front line, but you can also go in and say, hey, this is not a regulatory qualification. We can offer these to anyone. Let's do it with a targeted offer. You should be sending welcome messages every time you get a new account. You need a tool like DeepTarget to do that. Send welcome messages. Target those promotional campaigns of your competitors' promotion. You know when the competitors have done certain things. When those mature, 30 days before they mature, send people who you have an idea that they might be doing business with them. Send them a promotion. Let them know that you're there for them. So there's just all sorts of things that a digital offering can enhance any of the people who are using a core CD approach. So I wanted to just tee those up. And Matt, I think it's time for questions.
Yeah, thank you, Neil. Just so all the attendees know, we will be sharing a method of contacting both Jim and Neil if you'd like to get in touch with them directly for a private conversation. The first question that we have, I'm going to put a little bit of a front end on it. From what I understand, it's for Jim. Often you mentioned tailored offerings and precise offerings for depositors. And often the farther down that path an institution goes, the more the content multiplies. The more audiences you do, the more marketing has to handle. How are you seeing in your customer base institutions handle the scale of tailored offerings to be able to take advantage of the things you're talking about?
So that's an excellent question, and that's where technology comes. You could never do it. You could never do it on your own, right? So the idea is when we take your account holder database, we're gonna create audiences for each of the different offers, and that's where we can send an unlimited number of messages to people. I picked that number. If you have 25,000, we can send 25,000 messages. What we're also able to do is, if you get overwhelmed, and we have had, and it's a true story, we got a message, turn it off. And that's a good message, right? And we can turn it off. And the reason why we can, and it was for mortgages. This is when there was a little go-go period. And like, if I get, literally the message was, if I get one more mortgage application through your marketing system, I'm gonna strangle you. Can you turn it off? So the answer is we can turn it off, but that's probably not what we want to do. With deposits in particular, we have a link. It's called a deep link in our system where we can put them right into the automated online account opening tools. So, and literally the button isn't learn more, the button is start now. And when you start, you click start now or apply now if it's a loan, etc. It goes right in and it automatically does it. But basically, as far as the targeting goes and as far as it's as bifurcating your account holder base, that's what our system does. So you can have as many campaigns as you want, as many audiences as you want. And we do find, answering your question, that it doesn't get all the way to the individual. I'll just make up a number. If you've got 25,000 people, there's going to be 1,817 that are really good. Their next best product is an auto loan based on their portfolio. So we can do as many as you'd like, but we do find that we put them into the buckets of what makes most sense. And there are, I didn't know this number, and ask yourself if you know this number. How many products and services does a bank or a credit union offer typically? And it's funny because I'm not gonna ask Neil to put him on the spot, but it's 17. And I never knew that. So there's really 17. So if you do auto loans, blah, 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 home, HELOC, et cetera, you count those down, it's 17. So there's really 17 primarily, there's obviously other things that we can sell, but the 17 products are the ones that our system is really set up to go after. Great question.
The second one, and this one is for you, Neil, and you mentioned new money only when you were talking about your checklist. When you look at a marketing channel like this and a topic like new money, a topic like how do we keep from repricing the funding book, how does a channel like this strike you within that sort of topic? How can it make marketing more powerful?
Yeah, so you'll find that when we put together our deposit best practices list, without the ability to target offers, we tried to walk that line of saying, what could you broadcast and probably end up in a good place all the time? So we just acknowledge right away, there are the things you disclose. Well, those aren't your best rates. There are things you promote. Well, you promote them, but you promote them for only a short period of time so you don't reprice the whole book. And the negotiation and the retention are where you actually make the final offers. These are the best offers. and there's skill and there's art and science to these things. The ability to do targeted offers make it much more science and a lot less art. And there's still art in it. I'm not saying, like, some of the things Jim knows how to do in terms of how to phrase things, that's art, and it's really good. But what you get with the science of digitizing is that you don't just casually tell everybody about it. You tell the right people at the right time about the right offer. And so this list is kind of generic in terms of, hey, it's probably okay if you broadcast them, but the ability to be definitive about who's going to hear a certain offer, then the negotiated or those preferred offers, you're getting them in a much more offensively positioned approach rather than defensively, which is the retention approach. I hope that makes sense.
Thank you, guys. Those were the two questions we had from the audience.
Okay.
Just to wrap it up, all of you will be receiving tomorrow an email with the recording as well as the slides from this presentation. And we will include ways for you to contact both Jim and Neil if you need that.
Matt, I do have one that I'll throw out there, because as Jim was talking, and I know a little bit about, obviously, about DeepTarget, but could you tell the audience how you're looking at AI, generic? Obviously, you're using some things to do your messaging. Where do you see AI in what you're doing and in the industry in general?
Yeah, so what we do with AI, so literally we were early adopters on AI. So one of the things that I tell people all the time is, you know your bank and you know your credit union. Our algorithm knows other banks and other credit unions. And so one of the things that we do is we have a predictive model inside of that. There's different ways to target, but one of the things is a predictive model, which uses artificial intelligence to sort out a list of, using the predictive model, how many people would put in a $25,000 CD. And some of what goes into that algorithm is some AI and machine learning thinking based on what's happened in history before. So you are really gaining it. So yes, and I mentioned the word AI was on one of my slides in the corner. It talked about when we take your data in, we are running some AI analysis of your data to do the targeting so that we know who. If you don't know who to target, our system does know who to target. And so that's where that algorithm, and it's a very early adopter of AI, actually. We've been doing it before it was cool, so to speak. It's not the same thing where you ask ChatGPT a question and it loads it down automatically, but what it does do very quickly, it says, give me a cohort. I need, in fact, I'll tell you a quick story related to that. Somebody simply said in an email, this is the marketing team of one, I got to get some new deposits in here. That's all we got. Right? Okay, we have your data, into our system we go, run the predictive model, give us the highest propensity candidates to put in some new deposits. And I think Neil saw this. I did a presentation at a conference where we both met, actually. And we ran that and we got $7 million of new deposits. We started it on January 6th, and by January 31, 7.6 million and 367 people took action. And that was all AI. All they did was, we got to get some new deposits in there. And then the targeted ads and the new deposits came in. So this really does work, and I really do hope that we can show you individually what it looks like on your platform at a later date. But yes, AI is a big part of what we do.
And we know that there's a regulatory angst about AI, but the way you're using it is not putting the bank in any jeopardy at all. You're simply identifying the propensity for certain things to happen. And why wouldn't we want to use all that data? It's really business intelligence that's being harvested with those tools. So I'm super pumped about that. All right. Well, thanks for responding to my question. Matt, I think that's it from my standpoint. Anything else we need to cover?
No, thank you both for hanging on longer for additional questions, and we'll get everybody the information on this presentation afterwards.
Okay.
Marvelous.
Thank you, Neil. I really appreciate the opportunity to talk to some of your friends out there in the industry. And I do enjoy, as I said, I've taken a bunch of notes. I get educated every time you're talking. So it's been nice to get to know you. Appreciate this.
Likewise. It's been fun.
All right. Take care.
Thank you both. Have a good day, everyone.
Bye-bye.